Taxation. Federal tax laws change from time to time, but there are some things you need to know. First of all, you need to know that the U.S. tax system is based on a progressive tax. The more you make, the more you pay. You also need to know that in order to accomplish this, they take your gross income minus deduction, which gives you your taxable income, and then that puts you in various marginal tax brackets that go up as you make more money. There are a number of things that are deductions from your gross income. One of them is mortgage interest, not just on one home, but on two homes. So you can have two personal residences and still deduct the mortgage interest. Mortgage discount points are also deductible. Mortgage prepayment penalties, because since they're really no more than mortgage interest, are also deductible. Property taxes are deductible. And since we're talking about federal taxation, there's a tax loophole concept called depreciation, which is also deductible. In fact, depreciation is not an option, it's mandatory. You must take it on investment-type properties. Tax credits are a dollar per dollar deduction right off the top of your tax. There are a few of those available to consumers to use at this time. But as the economy is trying to be stimulated in certain areas, occasionally Congress will amend the tax law and have some tax credits of one kind or another. If you owed $6,000 in taxes and you were eligible for a $3,000 tax credit, usually because of something you've purchased, then you would send the IRS $3,000 of the $6,000 you owed plus a receipt for the $3,000 item you bought, and that would, because of the dollar per dollar deduction of a tax credit, satisfy your tax liability. There are personal residence rules when selling a personal residence. And this is a great program the government has put into place right now because one individual who's a single owner of a property can defer from gain, actually it's tax-free, $250,000. If you're married filing jointly, it's $500,000 in gain. The old rules of the residential rollover rule and the once-in-a-lifetime exemption are not in effect any longer. It's just $250,000 for an individual, or for married couples filing jointly, $500,000 that can be tax-free when you sell your residence. You don't have to invest in anything else. You can use the money for whatever you want. There's also a provision in the tax code that allows for 1031 tax deferred exchanges. When you do a 1031 tax deferred exchange, you must trade like for like properties. Now, that doesn't mean condo for condo. It means investment property for investment property. It could be vacant land for the condo, or it could be vacant land for an apartment building or an office building. But those are still considered like for like. You cannot trade your personal residence in a 1031 exchange. That's okay. You don't need it anyway with the $250,000 or $500,000 tax-free law that's in effect right now. So it's an investment property for another investment property. That's what like for like means. There's a concept in 1031 exchange called boot. Boot is not Tony Lama or Dan Post. Boot is personal property, cash, or net mortgage relief. If you go into exchange with a $50,000 mortgage and you leave the exchange with a $40,000 mortgage, you've received $10,000 in boot in the form of net mortgage relief and will have to pay tax on a $10,000 boot. So to arrange exchanges for the best tax benefit, you do not want to receive boot. You can pay boot, but you cannot receive boot. So if you're trying to accomplish a total tax deferral under a 1031 exchange, you don't want to receive boot, you only want to pay boot. The cash in the personal property that's called boot is used in exchange to balance out the equities. So if you were trading $50,000 of equity for $75,000 in equity in another building, you'd have to give your property plus $25,000 to boot. And that's where the term boot, B-O-T-T, comes from. There's a concept called capital gains in taxation. Capital gains is figured by taking your adjusted cost basis or your cost basis in a property and deducting it from what you sold the property for minus any sales expenses, and then you get capital gains, and that's what you're taxed on. The difference between adjusted cost basis or cost basis, both terms mean book value, but adjusted cost basis factors in depreciation. There are some properties that you cannot depreciate, like land or your personal residence. And so on those properties, since there's no depreciation taken on them, its book value is just called cost basis. But if you have an investment property that has improvements and depreciation was taken off, then what happens is you have adjusted cost basis. Both terms mean book value and are used to determine whether you have a capital gain on a property or not.